Why the housing market is not a bubble that's ready to pop. Hello, this is Rima Rafeh with the Rafeh Group at eXp Realty. Homeownership has become a major element in achieving the American dream. A recent report from National Association of Realtors finds that over 86% of buyers agree that homeownership is still the American dream. Prior to 1950s, less than half of the country owned their own home. However, after World War II, many returning veterans used the benefits afforded by GI Bill to purchase a home. Since then, the percentage of homeowners throughout the country has increased to the current rate of over 65.5%. The strong desire for homeownership has kept home value appreciating ever since. So let's go back and see what caused the housing crash 15 years ago. Back in 2006, foreclosures flooded the market. That drove down home values dramatically. The two main reasons for the flood of foreclosures were many purchasers were not truly qualified for the mortgage they obtained, which led to a lot more homes turning into foreclosures. And the number two, the number of homeowners cashed their equity on their homes. When prices dropped, they found themselves in an underwater situation. Many of these homeowners walked away from their homes, leading to more and more foreclosures. This lowered neighboring homes' values even more. This cycle continued for years. So why today the real estate market is different? And here are the two reasons today's market is nothing like the one we experienced 15 years ago. Today's number one, the demand for home ownership is real and is not artificially generated. Running up to 2006, banks were creating artificial demand by lowering lending standards and making it easy for just about anyone to qualify for a home loan or refinance their equity on their current home. Today, purchasers and those refinancing a home face much higher standards from the mortgage companies. There's always a risk when a bank loans money. However, leading up to the housing crash 15 years ago, lending institutions took on much greater risks in both the person and the mortgage product offered. That led to mass defaults, foreclosures, and falling prices. Today, the demand for home ownership is real. It's generated by the evaluation of the importance of home due to a worldwide pandemic. Additionally, lending standards are much stricter today in our current lending environment. Purchasers can afford the mortgage they are taking on, so there is little concern about the possible defaults. If you are worried about the number of people still in forbearance, you should know there is no risk of that causing an upheaval in housing market today. There won't be a flood of foreclosures. People are not using their homes as ATMs like they did in the early 2000s. And as I mentioned above, when prices were rapidly escalating in the early 2000s, many thought it would never end. They started to borrow money against their equity in their homes to finance new cars, boats, and vacations, etc. When prices started to fall, many of these homeowners were underwater, leading some to abandon their homes. This increased the number of foreclosures. Homeowners did not forget the lessons of the crash as prices skyrocketed over the last few years. Black Knight reports that tapeable equity, the amount of equity available for homeowners to access before hitting a maximum 80% loan-to-value ratio, or LTV, has more than doubled compared to 2006. The latest Homeowner Equity Insights report from CoreLogic reveals that the average homeowner gained over $55,000 in their home equity over the past year alone. The bottom line, the major reason for the housing crash 15 years ago was a tsunami of foreclosures. With much stricter mortgage standards and a historic level of homeowner equity, the fear of massive foreclosure impact on today's market is not realistic. If you are looking to buy or sell, or you have any questions in regards to today's market or the real estate market, please reach out to me at 661-236-8899.